Right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely check out the website at cubicleinvesting.com. Okay, so today is November the 16th. I want to talk about the trading activity or the market activity that took place this past week, particularly on November the 13th as well as the 14th. So on November 13th, apparently some news came out, some hawkish or negative or uncertain comments that were made by some Fed governors with regard to the interest rate cut not being a foregone conclusion at their next month's meeting, which is December the 9th and 10th, I believe, and the interest rate decision will be made on December the 10th. So because of that hawkish or, negative commentary from these Fed governors that the interest rate cut is not a foregone conclusion, that spooked the market, and the market actually dropped pretty significantly on Thursday, November the 13th. For those who have been following me, I like to trade the SPX zero DTE trade. And what I do is every day, I calculate 3 levels of interest, what I call, as I call them, 3 levels of interest, LOIs, on the call side as well as the put side. And these levels or these strike prices are essentially a point of reference for me to use if I'm looking to put on a zero DTE trade that will give me the highest probability, no certainty, right? The highest probability of walking away with the money. And so on November the 13th, these were my levels of interest on the call side, right? 68.90 was level 1, 69.10 was level 2, and 69.25 was level 3 on the call side. On the put side, level 1 was 68.10, as you can see. Bailey, you can see there. But so level 2 was 67.90 and level 3 was 67.75. Now what you see here so you see this green dotted line here, that represents 68.46. That represents 20 points above the opening price. And then the red dotted line represents at 68.06, 20 points below the opening price. So now my first cue to look to put on a zero DTE trade on the SPX is if the SPX moves 20 points above or below the opening price, because that 20-point move is a significant move from the SPX. And oftentimes it will mean that that's the predominant move that the SPX will move in throughout the rest of the trading session. Potentially, right? So when that 20-point move is made either to the upside or downside, I'm actually looking to place my position in the direction in which that 20-point move has been made. Now that may seem counterintuitive, but you'll see why here in a few minutes. On Thursday, the SPX, so this here's a 5-minute chart that you're looking at. So each candlestick represents 5 minutes worth of price action. The SPX actually dropped when the market opened. It actually breached level 1 very early on, and it dropped 20 points below the opening price at around 15 minutes after the market opened. Now that's very early in the trading session. And me not being patient, I decided to jump in at around this candle here, at around 10:05, 10:06 or so. I got into a trade and I placed my position on the put side because, again, the 20-point move, right, as you just saw, was made below the opening price. And so obviously it's going down. And so I'm looking to place my position in the direction in which a 20-point move has been made, and that was to the downside. So I placed my position at 67.10 and 6,700. So you can see here, this is a $10 wide spread, right? And as you can see here, here is the expiration date. So now I'm already in the trade very early on, right? Wasn't patient at all. And I'm normally very patient because I wait after that 20-point move has been made. I'm looking at the XLK sector. I'm looking at the market internals to get confirmation about the price action of the SPX. But I'm already in. So it's 10:05, 10:10. I'm at 67.10. So it bounces a bit and it begins to descend again. Right? It breaches level 2 now at around 10:50, 10:45, 10:50. And it breaches level 3, right? Which it rarely. So what I've noticed about the SPX, trading it over the last several years, is that the SPX rarely breaches my level 3. And my level 3 is nothing but 2 times the expected move of the SPX for, you know, whatever expiration date you're looking at. So my level 3 was 67.75. It actually breached level 3. So I'm already in the trade. I'm like, okay, this is going to be interesting. So it's beginning to drop. Pull up my pointer here. You know, it's continuing to descend, depreciate in value, bases out for a minute. You know, it bounces slightly. And so the lowest point, or the lowest price point that the SPX reaches or achieves on this day is 67.24. So now I'm at 67.10, right? So that's 14 points above my strike price. Now, normally what I'll do when the price is roughly around 20, 25 or 20 points or so within my strike price, I will close out the trade and just take a small loss, or I will roll the trade depending on, you know, what news is being released, you know, the next day or the next 2 days. So I'm always, you know, cognizant of what news items are going to be are on the horizon, because I don't want to roll into a day where there's going to be like a CPI report released or something like that. But nonetheless, the government has just recently opened, and so none of those metrics have been released because they are released by government organizations. So that data has been non-existent for quite some time. At any rate, it's at 67.24. I'm at 67.10. Okay, I'm like, okay, I got to make a decision here. Do I close this trade out, you know, take the loss, or do I stay in it? And so I ended up staying in the trade. I don't recommend this, and I know better. But again, I've journaled about this. And so I made this could have been, you know, a pretty decent loss, you know, on this day, because you're talking about a $4 wide spread. So that's $4,000, right? I got four contracts, but nonetheless, I stayed in the trade and I was able to walk away with the money. So as you can see here, the closing price was 67.37.49. And again, I'm normally patient because of that 20-point move very early on. I should have known better, and I do know better, in that I should have waited to give the trading session time to mature so that I can gather more price action information from the SPX. And so oftentimes I'm asked the question, oh, Eric, why do you trade? Why do you prefer to place your position in the direction in which the 20-point move has been made? Because it seems counterintuitive. It seems like you would rather go on the call side and be above, or, you know, allow the price action to move away from your position if it's dropping and you're on the call side. Well, let's look at what happened on Friday. Right. So here is the chart from Friday, November the 14th. So the opening price on Friday was 66.72. 20 points above that was 66.92, and 20 points below was 66.52. So as you can see here, when the market opened, the SPX immediately dropped 20 points below the opening price, and that was actually the low for that particular day. That was the lowest price point that the SPX achieved. So it dropped 20 points below the opening price. I got in immediately because I figured, okay, since on Thursday the market dropped significantly, that Friday we were probably going to get a bounce on this day, November the 14th. So as you can see here, here is the vertical spread that I put on. So I went to 6,600, 65.85. So a $15 wide spread. And I got in, as you can see here, at 9:48. And I placed my position on the put side because the 20-point move was made to the downside. The 20-point move was made 20 points below the opening price. Excuse me. And so yeah, so I kind of figured that we're going to get a bounce, and we did. And for the entire trading session, the market just pretty much just went up. Here's the high price for that particular trading session. And so around 12 o'clock or so, my position was so far out of the money that it was an easy position to stay in and allow the position to expire on its own. So that's the reason why, I look to place my position in the direction in which a 20-point move has been made, because oftentimes, well, maybe not oftentimes, but there are times where the SPX will make that 20-point move and continue to move in that direction very strongly, but then throughout the trading session, it will actually reverse in direction and begin, to move just as strongly in that opposite direction. And so I like to, to place my position in the initial direction in which a 20-point move has been made, because again, that reverse is always possible. And Friday was the epitome of that reverse. So had I went on the call side, assuming that, it was continuing to go to the downside, my position would have been threatened as the price of SPX continued to increase in value throughout the trading session. So real quickly, just how do I come up with the levels of interest? So it's just looking at the cost of a straddle, right? Or you can look at what would be the credit that you would get for selling a straddle, but I just always do the cost of a long straddle. And oftentimes this number will be same or will be in the neighborhood of the expected move from the platform, but not all the time, right? Because there are news items that can be released that can actually impact the cost of the straddle, and that happens very frequently. And this cost of the straddle will be significantly different than the expected move from the platform. And so, the cost of the straddle would just be level 1, the expected move. Level 2 on each side will be 1.5 times the cost of the straddle. And then level 3 on each side would be 2 times the cost of the straddle. And you just add it to the value of SPX. So hopefully this was helpful. If you guys haven't already, please subscribe to the channel and also like the video. And thank you for watching.